We have Ajay, Kaul, CEO of Jubilant FoodWorks, joining us right now. Thank you so much for joining us, Mr. Kaul. Jubilant Food numbers relatively weaker than what was expected. Your PAT is down even more than the markets expected. Net sales didn't pick up. And the biggest thing that the markets are worried about is the same-store sales growth. I don't know whether that worries you as much as the markets.
Given that in some of the yesteryears we have clocked as high as 37% same-store growth, then we did 30 and so on. So we have a precedent and the expectations are also thereby high. But having said that, same-store growth is also an indicator of the health of the franchise in terms of profitability and so on. While it does, take a lot of our time and we are constantly trying to innovate, whether it is in terms of new products, new launches, bringing efficiency into our existing stores to make sure that we get more out of our existing stores. But a number like that, while, is far better than what some of our honorable opposition is delivering, we are also getting market share gains. I mean, I don't know whether you have seen the Euromonitor report. We are the largest MNC QSR brand. We are 20% bigger than the next largest player. Our market share has also increased last year 67%, this year around 72%. But all those numbers have their place.
Sorry, could you just explain?
But net the same store growth number does
quick
worry
service
us.
Restaurant, right? QSR is quick service restaurant?
That's right, that's right.
All right, yeah. Go ahead, sir.
That's right, that's right. So the same store growth does worry us and it takes substantial amount of our time. But honestly, as I've always said, we are as much or more focused on building a company for future. If you've seen last year, we delivered 150 new restaurants for Domino's and around 20 for Dunkin'. This year, our commitment or our guidance is that we will deliver at least 150 new stores for Domino's, profitable stores that is. We always are very particular about the payback periods, return on investment and so on. And similarly, at least 25 for Dunkin'. At the same time, we are also investing a lot in building 4 new commissaries in our business, which are all basically are future looking in terms of building company for future. So if you ask me, as much as we focus on same store growth, we are focusing on future and trying to keep a right balance so that as the numbers change, as the consumer sentiment improves and the whole industry comes out of the woods, and at that time, Jubilant FoodWorks should be running faster than everybody else to capitalize on the opportunity.
Mr. Kaul, do you analyze same-store sales growth in terms of the number of years a store has been around? Do you have those numbers in the sense that obviously a same-store sale growth is only valid if a company has been there for more than 2 years, right? If a store has been there for more than 2 years, so do you have a breakup of that as well?
See, the extent to which we do same-store analysis, this is just probably 1/20th of the kind of analysis we do on same-store basis. On the aging axis, which means longevity of the store, how old is the store, which part of the country does it come from? Is it a metro? Is it a tier 1, tier 2, tier 3? Is it more dominant on the delivery side or on the dine-in side? What kind of splitting is happening around the store? What is the extent of competitive activity around the store? So we have probably 10 axes on basis of which we kind of do this analysis.
So I'm just trying to understand two things. One is that are you seeing...
I would say...
I'm just understand two broad things. One is, are you seeing same-store sale growth going down in older stores, or is it because newer stores are not really picking up that much beyond a certain point? That's the first question.
No, I was actually coming to that. Funnily enough, the good news is that, all this analysis is saying that every kind of store is getting impacted, irrespective of region, age, whatever, almost in a similar fashion. Statistically significant differences are not there. That is the good news. It isn't that Domino's Pizza is not doing something well in a certain area or a region or a city or a tier or maybe, against the age axis. The bad news, however, is that it's obviously a countrywide issue all stores, all consumers in the country, irrespective of what life stage they are in, against our industry and against our brand, are behaving equally badly, which means they have pulled back on consumption, the frequency of consumption is dropping, acquisition of new customers is also in some ways getting affected. And that's probably the industry level issue where all of us together, I mean, if you have seen numbers reported by some of our honorable opposition in the last 15 days, McDonald's, Yum and everybody else, they are clearly worse hit than we are. Now, we don't derive joy out of that because our own number, minus 2.4%, is not a great number. Yeah. But there is a consumer sentiment issue. We believe that despite all optimism that we have had, it has continued for a bit too long. We believe that it may continue like this for at least another 1 or 2 quarters. And it's only after that that we could probably see some definite change in consumer sentiment. But till then, we are fingers crossed and hoping that things change.
So, in much of the West, some of the QSRs or fast food restaurants are trying to give healthier options. I mean, I, for instance, have always eaten one particular Domino's pizza, which is the thin crust pepperoni with extra pepperoni. Now, I have reduced it simply because of my doctor. Now, do you think that in India as well, that is one concern? Because yesterday we were seeing Talwalkar's numbers way beyond what was expected and Jubilant Foods numbers lower than what was expected. So do you think health concerns is also affecting you in some of the areas?
Not at all. I would not say. While I have respect for, the health vector, and there are a certain group of people who are becoming conscious, probably health as, I would say something to think about, is coming faster than probably it came in the West in the evolution of brands and so on and so forth. But India is such a large country, and if I look at you probably may not be our core target audience. The mass of people, the middle class, who consume us probably 2 times in a year, 3 times in a year, and that's the kind of average I'm talking about. For them, health is hardly a concern because they say it's on that special occasion, on that birthday of my son or my wife or something like that, did I consume, let's say, a Domino's pizza or something like that. And so why should I be, in fact, even thinking about health? But having said that, we still believe, honestly, that a pizza at the end of the day is not, it should not give you concerns about health. I mean, if you look at what goes onto a pizza, there is nothing fried there. Every other, food in India is fried. Pizza is not. It has got a protein supplement in the form of cheese. You may argue that, is cheese very healthy? But had in good proportions, it's not bad. And then there are fresh vegetables. There is protein sitting there.
The point that
so
you're
to
making
me, it's a
here is
healthy
valid.
baked food.
Mr. Kaul, the bigger point you're making here is valid, that given that it's only 1 to 2 times on an average that your consumer buys it, they're probably not really concerned about health as much as they are in the West. I'm looking at some of those numbers again. If I look at employee costs, it's really surprising that at a time when, unemployment is relatively high, you're forced to increase your wage costs so sharply. Is that a conscious decision to pay more than the rest?
See, given that we are growing fastest in the marketplace, 150, 175 new restaurants every year means 1 every 2 days. We do have to invest a lot in terms of building pipelines for leadership, which means store managers, district managers, going all right way up to the top. And also, as we are going into far-flung locations in the country, we have to build bench strengths of our front-end employees. But that's a regular game. I mean, I don't see that lending costs into additional costs into the system, because even 2 years back, 3 years back, we were kind of, working on the same principle or model. However, what is happening is when your same store growths are -2 and -3%, there are minimum wages declarations which happen. It's a state subject, if you're aware, which come as, some sort of a diktat which you're not able to control. So while we control the, voluntary, wage increases which we do from our side.
Is the competition from e-commerce also affecting the...
No, I don't. While you maybe no. It is not giving us concerns at all. I mean, yes, there'll always be competitors. Being the largest player, we are always a good pool for front-end staff, delivery people, managers and so on. but it is not giving us concerns. It is something which, we have to handle by and by.
Some of the e-commerce competitors actually don't have to earn any money because they are entirely valuations driven. But you have to, at the end of the day, show earnings. So that competition from e-commerce for delivery people doesn't affect you?
No, that's what I was saying. See, we have instances in our company where the delivery boys, what we call the safe delivery people, have gone on to become general managers and vice presidents also.
Okay.
The e-commerce companies, firstly, are new in the market. They can't offer careers like these. So there's a lot of talk in the media about it, but honestly, it is very marginally impacting us.
Okay.
We have requirements of 10,000-15,000 such people, whereas the e-commerce guys are probably recruiting a few. So far, no concern. But talking about e-commerce, I just want to share a few facts with you. Despite, minus 2% same-store growth and all that, the investments we are making, on new stores I have spoken about, investments we are making on e-commerce. Today, nearly 23-22% of our total delivery orders come through the internet. And out of that, nearly 21% actually are through the mobile phones. So that is something which we are putting a lot of money behind.
But that still ultimately goes to a store,
and
right?
we believe that as industry numbers start improving and we come out of the woods, we would hit the road running compared to our competition.
So, but even then, that ultimately goes to a store, right? If you actually order online, doesn't it go to a store?
It does.
Wouldn't that still be counted as a store sale?
It does.
It does. All right. One final question on pricing. Now, you have been able to, I think, do a little bit of take up prices a little bit in some of the key sectors, but you're also offering quite a bit of discounts, especially, I think, on online orders. Is that going to continue for a while?
Indeed. Between the online and the offline, I must admit, because we want to promote online medium, the discounting which we do on online medium will be marginally higher. But we are also conscious of the fact that on the offline medium, in a tough environment like this, the tendency is to probably give a few more discounted offers and so on. But we watch that space. Personally, I watch that space on a weekly, monthly basis. And we are very, very, should I say, cautious about, like hawks, as to we should not, go crazy as far as discounting is concerned. And we are controlling it.
All right. And also, in terms of Dunkin' Donuts, you said that you're going to be adding more stores this year. When do you start expecting it to start delivering a significant portion of your revenues or even your earnings overall?
See, Dunkin' Donuts, even, let's say, looking forward 2-3 years from now, when probably we'll have 100 Dunkin' Donuts stores, at the time Domino's probably would be maybe 1,200, So in terms of revenue contribution to Jubilant FoodWorks, it'll always be small, and we need to kind of understand that.
Okay.
But the impact on the EBITDA, like currently in this year, we believe it may... the Dunkin' business is probably going to hit the bottom line by nearly 150 basis points, which means reduction in Domino's EBITDA numbers. Progressively, we believe in the next 2-3 years, it will come down to zero, obviously. So we are working on it, and I think we have almost getting to the model which we believe is the right model for the country in terms of size, store size, format, pricing, menu mix, and so on. And some of our new launches, for example, in Mumbai, which you must have seen, was a roaring success. And now, encouraged by that, we are going to Bangalore in the next couple of months. We will then be going to Pune, Hyderabad, Chennai. So we believe we are on the right track, and we are very optimistic about Dunkin' Donuts.
All right. Did I get that right? You're saying that a 150 basis point additional impact on EBITDA margins overall for Jubilant Foods from Dunkin' Donuts this year?
Not additional. Compared to last year, it will be 30 basis points. But over the last 2 years, ever since Dunkin' has started, it has almost 150 basis points impact on the Domino's P&L, and it brings it down by that extent.
And if I look at the current EBITDA that we've seen this quarter at about 12.4%, which is one of the lowest that you've delivered, what kind of improvement do you expect, or should one factor in the fact that you're going to see some losses on the, not losses, but some EBITDA margin contraction as you increase your online presence, some contraction from Dunkin'. Do we expect this to be at 12.4 or will it go lower?
See, without offering any guidance, which we never do on the EBITDA number, or we have stopped doing that, I would reckon that till the point there is an inflation, a weighted average inflation, keeping everything into mind, labor, rental, general inflation of commodities and so on, in the tune of around 6 to 8%, which kind of comes to us as an impact. Till the point our same-store growths don't climb back to those kind of levels, there will be a constant pressure on EBITDA. We are using all Six Sigma techniques, cost efficiency models internally rigorously, and that is obviously giving us some gains. But the moral of the story is that you have to get back to at least the 6 to 8 number, same-store growth number, to at least maintain your margins. And anything more than that will then make the margins grow further. So that's my submission to you, that it will probably take at least a couple of quarters for the consumer sentiment to clearly show signs where we will start improving on our same-store growth.
So would it be fair to say that one should be prepared to get a slightly low EBITDA margin number from Jubilant Foods for the next 2 to 3 quarters, especially because you're saying there's pressure from Dunkin' Donuts side, which you're giving us a guidance in the sense that a 30 basis points impact going ahead?
See, which is already in our Q1 number also. So to that extent, it should not go worse from here, because Dunkin' Donuts impact has already started coming in. The incremental impact has already come in Q1 also. I would not hazard a guess or kind of give you any indication, but there is pressure on EBITDA margin, no doubt.
Well, thank you so much for joining us. Pleasure talking to you. Very interesting
Thank you.
Chat.